right, welcome to Cogent Strategic Wealth's webinar, Caring Well, the Basics of Long-Term Care Insurance. In today's webinar, you're going to learn how you can take care of yourself and your family by securing your future with long-term care insurance. None of us want to think about the health hurdles we could potentially face in the future. If you have spent your entire life building your wealth and planning for your financial future, the last thing you want is unforeseen circumstances to derail your plans. There is perhaps no other event in life that has the potential of causing serious, if not irreversible, consequences to a family than a need for care over an extended period of years. If you are in your 40s, 50s, or 60s, securing your future with long-term care insurance can be a great way to mitigate risks and bring peace of mind to you and your family. Big dreams require a plan. Caring well today can bring you big rewards in your future. We hope you'll feel a lot more confident and relaxed about your family's financial future, especially in providing the dignity and independence to you or someone you care most about in their later years. Now, a little information for you before we begin. During the webinar, please ask any questions you may have through the question and answer feature on your Zoom screen. Clicking on the Q&A button at the bottom of the Zoom screen will allow you to type in your questions. Any questions that we are unable to get to directly today will be answered by our Cogent team soon after the event. I'm Kelly Stanley, Wealth Advisor at Cogent Strategic Wealth. I am joined today by my colleagues, Michael Evans, Founder and Fiduciary Wealth Manager at Cogent, and Michael Tessler, President of First Element Insurance Planners. I'd now like to introduce my colleague and host of today's webinar, Michael Evans. As I just mentioned, he is the founder and fiduciary wealth manager here at Cogent Strategic Wealth. Together, Michael and I provide financial and investment strategies to high-achieving professionals for securing their financial future. Welcome, Michael.
Thanks, Kelly. Appreciate it.
I'd also like to introduce our special guest, Michael Tesler. Michael is responsible for communicating First Element's wealth transfer and wealth protection strategies to individuals like you and me. He commonly speaks to professionals and their clients about various planning strategies utilizing life insurance and long-term care insurance. At Cogent, we benefit from Michael's abilities and insights, utilizing his team's capabilities to deliver customized risk management solutions to fit the unique circumstances of our professional clients' situations. Michael Tesler, welcome to Cogent Strategic Wealth's Caring Well webinar.
Thank you, and hi to both of you.
All right, I'm going to go ahead now and turn it over to the Michaels.
Wonderful, wonderful. Thank you, Kelly, and I appreciate so much the positioning that you did about how complicated and volatile life can be. As you mentioned earlier, none of us want to think about health hurdles that we're going to face in the future. As a busy professional, you are just so in tune, like I am, with doing the things that really bring me joy, from working to family and whatever, and also just spending time with those that mean the most to me and I love. However, there is a fear out there, and a fear is, am I prepared for my later years? Many of us see the generation above us suffering and going through some hard times, and it's an impetus for us to step back and actually think about, where are we at? So we're going to answer the question for you today of, how can I maintain family harmony, avoid all of the time-consuming and expensive problems that I might face? How can I limit the hassle to my spouse or my adult children? All of those things will be answered today, in how to provide you and your family with the care you need as you age and care well. So a solution that we are going to propose, you may want to consider, and one that we often ask our clients themselves to implement, is a long-term care solution. And I'm really excited today that we have an expert with us, someone that has deep knowledge and great experience in delivering that to professionals like us as advisors, and also our successful and high-achieving clients. Michael, welcome. This is great to do this together with you.
Thank you, and thanks for having me.
Oh, my pleasure. Our pleasure, actually. Kelly and I really enjoy this part of our job. Education is essential for consumers to make good decisions for themselves, and we just want to be a part of that solution. So, Michael, we hear so much about long-term care solutions out there. It's in the news. The industry has changed so much. would you do us a favor and give us an overview of why planning for a long-term care issue today, long before it ever shows up, is just so important?
That's a great question. And in fact, let me just jump ahead here a second. And, when you start talking about who needs long-term care, here's the bottom line. I could give you a lot of statistical data around why, from a statistical standpoint, you just can't ignore this. And I will admit, when we used to talk to people 20 years ago, we talked a lot about statistical data with the idea of, we're going to motivate you to buy this stuff or whatever because you need it, because there's such a high probability that something may happen to you. And I will tell you that pre-COVID, when we'd have discussions with whether it was advisors, their clients, or both, you could stand in front of a room, no matter how large the room was, and say, everybody in this room who's had a situation involving a chronic illness in their family, raise your hand. And literally every hand in the room goes up. Grandparents, parents, spouses, whatever the situation. But the truth is, that's not exactly why people want to and actually spend the time addressing this subject. It has a lot more to do with what drives and motivates all of us. And for a lot of people, we've spent our entire lives trying to take care of those we love, whether it's spouse, children, or combinations thereof. That's what we've all want to do. And the last thing anybody wants to think about is not taking steps in their world that makes it easier for the people that they care the most about. The sense of purpose that all of us have in this life, in many instances, is connected to how we take care of those that are most important to us, our loved ones. And when it comes to the commitment that we have made to these people, we know that the consequences of a long-term care situation go way beyond just the financial part of it. But it's really about, how am I going to do the right things in terms of what I do for the people who are important to me in my life? For many, that purpose that we have, it's an instinct to provide and to care for the people that are most important to us, and to make sure that we don't do anything that puts them into a bad place. Even if it means sacrificing myself or my own health or whatever the case may be, to make sure that the people I care most about are not put into a bad situation. So recognizing the consequences is a really important part of understanding this, not just the financial consequences, but also the consequences to our families. Providing care to a chronically ill person, to be honest with you, will make you chronically ill. I mean, it's a terrible thing to say, but it is incredibly hard on the family. And there's a lot of resentment. Who's going to be the one to take care of the person that needs it? And if there's multiple children, that can really start to become an issue. The well-being of the people that you've spent your whole life caring about actually gets put in jeopardy if one or more of them starts to become a caregiver for you. It is almost never the case where there's an equal sharing among siblings, and it causes a lot of problems. And here, for many parents, they've gone through their whole lives trying to make everything as smooth as it can possibly be for their children, and yet this is the one thing that will absolutely drive a wedge between them. Sometimes it's because children live in other cities. That suddenly the child that lives in the same city as the parents somehow becomes the chosen one for caregiving and decision making and all kinds of things. And it can really cause friction between the children in a family. And this is never a situation that brings kids together. And unfortunately, one of the consequences that you have to recognize in all of this is, if this happens and I leave this in the hands of my children and they're making difficult decisions and somebody is having to give up some or all of their life to care while the others are not, there will be friction. And that is not something that anybody wants to make part of their personal plan as it relates to longevity. The future generations will, in many instances, I'm sure everybody here knows of families where long-term relationship damage has occurred because somebody had to do more than the others during a family care situation. And admittedly, the emotional and physical consequences are really compounded when there are second marriages. Why is somebody taking care of somebody else's parent, and why is money that would have come to the children from marriage one being spent for the spouse of marriage two, and all kinds of things around that. So second marriages really bring about a very, very difficult aspect to all of this. But to summarize and to answer your question, the answer to why so many people want to do this is because they recognize the consequences of having to pay for and provide care for somebody in the family. It's expensive and it requires resources, starting with income, but potentially other parts of the portfolio. There's people who have already made big plans about a big successful future and did not necessarily plan this into it. And unfortunately, it has great impact on what they do. The ability to shift income to pay for care means that other financial commitments may not be met. And that is a consequence that a lot of people kind of seem to not always recognize. So for a lot of people, it's asking the question, which thing are you not gonna do? And what I mean by that is, if you've got a child who has not made the best decisions and you're having to financially help that child, but then a long-term care or chronic illness situation comes up, are you going to decide to care for a spouse instead of a child? And do you want to be in a position where you have to make decisions like that? Are you contributing to a child's 529 program? Are you tithing? Do you have a favorite charitable organization? And if something happens that dramatically impacts your financial circumstances from a care situation, will you still be able to make the donations that you've been making? Is there a boat, a house, a family property, whatever the case may be, that you're saying, wow, I want to be sure that I don't put my family in a situation where we've got to make the decision between our favorite family vacations, our favorite club memberships, and so on, and not have the adequate cash to take care of ourselves. So as I was saying, you can kind of summarize it into, I'm going to take every step I can to make sure that things are as comfortable as possible for my spouse and for my children. And there's little doubt that a situation like this can really affect it. And that's why the long-term care situation is something that everybody wants to address.
Oh, wow, Michael, that's fantastic. What great insight into about all the other things. And I don't want to call them ancillary things because they're just so germane and material to families. And that insight is amazing. Maintaining family harmony with your spouse and with your children, and whether it's in first or second marriages, really can be debilitating and very important. So thank you for that. So you gave us a really good rationale there for looking at it. There's finite resources, and how do you do that? Now, would you take a moment to explain to us, to educate us on the long-term care insurance and just how it works, and then also maybe touch on a little bit of what are the solutions that you think, as an expert and knowing our types of clients, on what they should consider using?
You bet. Thank you. Great segue into exactly where we're going, which is, how does this stuff work? And the answer is, it's going to ensure all or part of the risk of needing care or assistance due to chronic illness. And one of the biggest misnomers in the market today is a lot of people think that, well, if I have medical insurance because I'm still in my working years, that insurance would cover this. It won't. The next thing is, well, I've retired, I have Medicare, and I have a Medicare supplement policy, so it will cover this. It won't. It's not to say that there are no benefits that would come from either your medical insurance or your Medicare supplement, but they tend to be very, very short in duration. And if you have a long-term, critical, chronic situation, not where you're hospitalized because you need to see a doctor every day, but you can't do some of the things that you normally do, that insurance is not going to cover it. So let's take a moment and talk about how does this actually work. Long-term care policies generally pay benefits when one of these two things happens. The first one is if somebody has a cognitive impairment. If somebody has a cognitive impairment, and that cognitive impairment is these are the really scary ones. I can't lie to you. And if you've been through this with a family member or somebody you know, a friend's family member, you have seen. These are the hardest ones to deal with. Somebody who has Alzheimer's or dementia and mentally is not there, but physically is hanging on. And sometimes you hear about Alzheimer's patients that live years and years and years, but do not literally know what day of the week it is. These are the scary ones. The second is somebody who cannot do 2 of 6 what we call activities of daily living. And if you ever read any articles in magazines, Art Magazine or what have you, there's a lot of talk about activities of daily living. What are we talking about? If somebody's not able to bathe themselves and feed themselves, or they literally can't get up out of a chair without physical assistance from somebody else, any 2 of the 6 that are on this slide, bathing, continence, toileting, eating, dressing, or transferring, would qualify you for benefit. So it's not either cognitive, it's not cognitive and this, it's one or the other. And all of these things will require certification from a doctor. And so it really kind of makes the claims part relatively easy. The doctors are questioned by the insurance company. There's a form that they complete that says, my client has dementia and needs to be looked after. Boom, qualify for claim. And so this is how it works. And as I said, when and where it pays in terms of the benefits from these. In the marketplace, there are 2 types of plans out there. One is referred to as a traditional plan. It is the oldest type of long-term care plan out there. And the second is a hybrid plan, which is sort of a marriage between a life insurance policy and a long-term care insurance policy. It's not to be confused with somebody buying life insurance. Nobody buys a hybrid plan because they need life insurance. That's a completely different part of this. And I'll explain that in just a few minutes. But let's now talk about the traditional plan. These are the oldest types of plans out there. They're very customizable and they allow somebody to pay, generally, initially anyway, a very low premium to obtain it. The problem with these plans over time is that the premium and the benefits that they provide are not guaranteed. And to the best of my knowledge, every major carrier in the market has not only raised rates on these plans, but the increases are massive. So if you're a business owner and you're used to your medical insurance going up 6% or 8% or 10% a year or something like that, this is in its own league. We're talking about 30 and 40 and 50% rate increases, and we're talking about it happening multiple times through the life of the contract. The other thing about these contracts that left a lot of people a bit concerned was that you could spend money for years and years paying for long-term care coverage and never use it, and the money's just spent. It's not coming back out. I will admit, for me personally, this is not as big an issue because I'll tell you, I don't spend money for my automobile insurance and at the end of the year think to myself, wow, I didn't have an accident, my car didn't get stolen. I'm kind of bummed out that I never got to use my insurance. Frankly, I'm thrilled that I didn't get to use my insurance. And so that's not a big one, but for a lot of people out there, for a lot of consumers in the market, their biggest concerns are around the fact that the premiums and the benefits are not guaranteed, and that they could pay for this coverage for many, many years, not use it, and all the money spent goes away.
Wow, Michael, that's that is so, you covered so many great things there. The first thing I wanted to comment on was you mentioned the memory care, dementia and Alzheimer's just being such a debilitating thing, not only for the person that has those diagnoses, but also for the family. The stress of finding the right place and everything, to paying for it, to making sure that you're comfortable is just so palatable. We've walked with many clients for their parents going through it with them. And it's tough. So thanks for touching on that. The
You
other
bet.
thing you talked about, and we hear this from our clients, for the ones that already have taken the appropriate steps of we have this great policy, we've had it for years. I completely agree with you, by the way. You don't buy home insurance hoping your house burns down, right? And so, but you never know, and so you want to hedge the risk. And if you do it appropriately, it's great. But what if the insurance company does raise it 30 to 50%? And what if you, now having finite resources, have to make some decisions about how you allocate? Now, what do you do? How do you deal and make these premiums more manageable?
That is a great question. And as I said, every carrier has raised rates. So if you're on this, if you're listening to us right now and you're saying, yeah, I'm one of those people, don't feel badly. It's not like you could have bought from insurance company A instead of B and you'd be in a different boat. Everyone's in the same boat. So I'm going to show you something right now. I'm not picking on any one insurance company, but this is a real letter from Genworth. And I can tell you that Genworth has the largest block of long-term care insurance business out there. This is impossible for you to read, so don't try to read this slide. I'm just going to point out a couple of key points. First of all, what Genworth is announcing here is a 50% rate increase to this client, okay? And what they are showing in these various columns are, you can accept the rate increase and keep all the benefits that you have, or we will scale down your benefits to help keep the premium a tad more affordable for you. So this massive rate increase, and I call 50% massive, here's the next scary part of this. This is from a letter dated in 2016. This client's already received this letter again. And oh, by the way, interestingly enough, although this format of this letter is 5 years old, the company is still using the exact same letter today to let you know that you're getting these very, very substantial rate increases. Now, the question about what can I do is, there are certain parts to benefits that you may wish to consider changing to help offset some of that premium increase. The first and one of the biggest ones is how long your benefit period is. So it used to be very popular for people to buy these with a lifetime benefit. In other words, it would pay long-term care benefits no matter how long you live. But we know that the average claim is not a lifetime situation. It's a few years. And so you might want to look at, if the average claim is much shorter than that, then lowering the period during which you can receive benefits. That will help keep your premium down. The second thing is that there's an elimination period, a period of time before your benefits kick in. For a lot of people, when they thought they were buying a Cadillac plan, they bought a 0-day elimination. In other words, as soon as you qualify for benefits, they would start kicking out the full benefit to you. If your finances are such that you can go 30, 60, 90, 180 days before you need the insurance to start paying, that is a very, very good way to help keep the premiums more in line with what you expected them to be. One thing that I get asked, and usually there's a hand raising right about now saying, well, if I own one of these and I got this massive rate increase, can't I just buy a new plan for less money? And what I will tell you is, even with these incredible rate increases, the new plans that are available, generally speaking, are still going to be more expensive than your old plan, even after the rate increase. So replacing it with a newer, supposedly less costly plan is probably not in the cards. Managing what you've got is also important. The second thing is that underwriting can be stringent. So if you bought this when you were 60 and now you're 78, It's entirely possible that your health situation would preclude you from being able to get a new plan. And as such, figuring out how to maintain the old plan within your budgetary constraints becomes critical.
Michael, that's great. I'm sorry, go ahead.
No, go ahead.
Yeah, no, I was just going to break in because you mentioned something I think that's really, really nice about this conversation, because I think it shows that there is communication between the client, their needs, their worries, and their challenges, and then also with their financial advisor. And us as their advisor can bring in people like you that can actually help the client make better decisions. But I believe it all starts with their financial plan. You mentioned if your finances allow or if you're able. A financial plan, and Kelly Stanley is our director of financial planning at Cogent, does a fantastic job of not only showing what's going to happen in your 50s, 60s, or 70s and how you can accomplish all your needs, wants, and wishes, but also what happens if the time bomb of a long-term care insurance occurrence happens towards the end of your life, and what that means not only for you, but for your surviving spouse and maybe even your heirs and their legacy that you want to leave to them. So I really appreciate you talking about that. And a financial plan, I think, is the first place where we start discussing that. So I have a client in front of me. They've worked hard. They've saved well, Michael. Tell me, they're looking at their financial plan. We show them that, and not ignoring all those other things that you talked about family stress and other things and stress to the person that's taking care of it. How do you judge? How do you lean towards the different solutions that are available, and speak a little bit to us about not only the traditional, but then of course, these hybrids?
That's a great segue to where we're going to go next, and that is this slide has already gotten very old, and forgive me, but if I were able to carry it out to 2021, the numbers only get more extreme. So if you go back in 2000, you'll see the traditional plans were the majority of the market and the hybrid plans were the minority of the market. And mostly that was cost driven because you could buy these traditional plans for less money than the hybrid plans. Unfortunately, as we just discussed, the rate increases on those plans were massive. And if you come out to today, it looks a lot more like this, even though this is several years old, where hybrid plans are the product of choice for people who are buying these plans for a variety of reasons. Let's talk about hybrid plans. As I said earlier, the hybrid plan is a marriage between a life insurance policy and a long-term care insurance policy. And it provides something that is very, very important to those who purchase these. Number one, the premium is fully guaranteed for the rest of their life. And by the way, you'll notice that I'm speaking generically. I am speaking about the better plans in the market. I am not here to tout one company's plan over another. I am, however, speaking about a group of plans that I consider to be the corral of the best plans in the market. The premium is fully guaranteed, as I said. Secondly, the long-term care benefit is fully guaranteed for the rest of their life by the insurance company. Thirdly, the life insurance portion is fully guaranteed for the rest of their life. The life insurance isn't there because this is a great way to buy life insurance. It's there for a completely different reason. And that is, remember when we spoke earlier about traditional plans, that one of the concerns was that you could put money into this thing for your whole life and then never have you never use it and never get the money back. With these plans, you put money into it, and if you are lucky enough to go through your whole life and never need the benefits and pass away, a life insurance death benefit would then be paid to your beneficiary. So when you look at the hybrid plan as compared to the traditional plan, it sort of answers all the questions that were of greatest concern to people who bought traditional plans. The premium's guaranteed, the long-term care benefits guaranteed, the life insurance or the benefit at death is guaranteed, and there's also generally a cash value. So if for some reason you decide that you want to get out of this plan, let's say the government decides that they're going to take care of everybody out of the goodness of their heart if they should happen to become chronically ill. By the way, for those of you that don't know, that was my little bit of humor into this thing. The government is never going to take any responsibility for this. The amount that is spent on this annually is beyond anything they could ever conceive of trying to cover. So that was a joke. But if you want to get out of these plans, there's actually a cash out option that would, depending upon the plan, return some or all of the money that you put in. There's a lot of different payment options. A lot of people like to pay for this stuff early during their working years, for example, and then be done with paying for it so that it is not an ongoing premium bill that comes in during retirement years. And it can be funded a number of different ways. For some people, they have used old life insurance policies that they no longer need that had cash value to fund these new plans. So lots of different ways to get the funding around these. But again, you've heard what are the really key points. So when people are looking at this, they like to think of it as something that is really about what happens if I live, what happens if I die, what happens if I quit. And that's what we like to talk about because it's answering the questions that people really have. If you live, statistically speaking, you're going to need care. And the plan is going to provide a very, very substantial benefit to help take care of some or all of the cost of care. As I said, if you're lucky enough to not need the care and you die with the plan, then the death benefit would be paid to your chosen beneficiaries. And if you quit, there will be a substantial portion of your premium returned to you in the form of cash value on this policy. And all of these benefits are fully guaranteed. You'll know exactly what they are from day one in any year as long as you own this contract. So let's take a look at a real live person here for a minute. This is a 55-year-old male who puts $100,000 into one of these plans. And let's focus on this year one column with me for just a minute. In year one, the pool of long-term care money will be $241,000, or it means that this person could draw down $4,800 a month in benefits over a 4-year period of time. That's immediately available and guaranteed to this person if they buy it. And this was also purchased with an increasing benefit, a 3% inflation option. If they die, there's a $223,000 death benefit that would be paid to their beneficiaries. And if they decide that they want to get out of it, $77,000 of the $100,000 that they put in would be available as a cash out option. Now, that said, I think I speak for Michael that we are both, shall we say, in the neighborhood of 55. I can tell you that neither of us is thinking to ourselves about a long-term care situation, and understandably so. At 55, as a male 55, I can tell you, you still have that sort of I'm invincible feeling, but that feeling tends to go away. Let's age ourselves 25 years and look at what has happened now that this person is 80 years old. And at 80 years old, you can probably give a little bit more thought around the possibility of needing care. By the time this person's 80 years old, the pool of money available for long-term care will have grown to nearly $500,000. The monthly benefit that could be drawn down is nearly $10,000. Again, it's the same 4-year period, and even beyond the 25th year, it will continue to grow by 3% a year. The death benefit at this point is $125,000. So if this 80-year-old is lucky enough to have gone through their life, they never need the benefit, the $125,000 will be paid out to their chosen beneficiary at death. And as I mentioned, there is a return of premium option. This will return 70% or $70,000 of the dollars that went in 25 years down the road. So if this person puts in $100,000, and if they have a claim, a whole lot more is going to come out than they ever would have thought about putting in. If they die, more is coming out than they put in. And if they decide to cash out, they're going to get 70% of their premium. But remember, they've had full coverage for 25 years, which is not an inexpensive proposition. So this is a This is a very real plan. This is how it works. And all of the numbers you're seeing in year 1, year 25, everything you see here is fully guaranteed by the insurance company.
Michael, that's great. Thank you so much for that. I got to say, the industry in the decade and a half that I've been involved in this is it's so changed so much. It's matured and grown up in so many different ways. And I think it's about time they started listening to the consumers. They realized they had underpriced it, and they had to come up with a solution that was much more palatable for them. So you mentioned 55-year-olds. I happen to share that with you, I believe. So think ahead. We are impervious still. We're somewhat still not feeling the
Here we are.
yeah, maybe, but we're really, we still have our heads to the grindstone. We're still serving clients, helping raise children, even though many of them are progressing along nicely, and caring for the people above and below us. But we're still working on, whether it's retirement or education expenses or even, saving for medical expenses in the future. How would someone like myself, say 55, with, a long-term vision of where myself and my spouse are going, how would we start to think about when we should consider buying a policy or at least pursuing some ideas on what is available?
That's a great question. And I have a really simple answer, but I'll give you a little bit more detail. The sooner, the better. And there's 2 reasons why. The cost of this coverage goes up. So I talked about on this particular slide, or the one before it, that I'm talking about all of what I consider the upper echelon companies in the market. Off the top of my head, I don't think I can think of one that has not increased the price of a new plan in the past year. They go up because these benefits are getting used and insurance companies are paying out a lot of money. Second, as you get older, the cost of this care goes up. And there will come a point at which, if you really wait it out and get into your 70s, the amount that you could pay for this can be rather startling. So I know it sounded a little bit like a flippant answer to say the sooner or better, but that really is the answer. Interestingly enough, the average age of who buys this is come down almost every year for the past decade. And as buyers of this start to recognize it, it just keeps getting lower and lower. It was close to 60, it's now down to 55, and I fully expect it's going to get lower than that very, very soon as insurance companies start to make it more attractive for younger people to start buying this. And certainly younger people are paying more attention to it as well. I will also tell you something else about who buys this. Everybody who's been through this with a family member. I don't have an actual industry statistic, but the number of people that have watched this work in their own families or who have been through a claim in their own families where it didn't work, they're very interested in this. I don't want to bore everybody here with my own personal sagas, but I do want to tell you something interesting. I have a lot of longevity in my family, and 3 of my 4 natural grandparents spent almost a decade needing care, and a lot of care. And I can tell you that my grandfather was a proud man. At one point in his life, he owned a store and had other businesses and things. And the bottom line is, between what he paid to care for my grandmother and what he paid to care for himself, he died destitute. And if I'd have told him that during his life, or if, God forbid, he knew it now, he'd roll over in his grave. He's just a proud man that would never have believed that he could have spent all of his money on something like this, but in fact he did. Interestingly enough, 3 of my 4 natural grandparents needed substantial care. But as you all now know my approximate age, I am now dealing with the next generation. So my father-in-law, my wife's father, spent 10 years at home with round-the-clock care before he passed. He lives in California, and I can tell you that if you've ever priced this stuff out, California is one of the most expensive places to get care, and 24-hour a day, 7-day a week in-house care is about the most expensive way that you can have care. And I can tell you that the amount of money spent was absolutely phenomenal. So I'm just watching it move down. I can still remember as a child visiting my great-grandparents in a nursing home facility. And so, I mean, every generation, it's just moving down. So clearly, somebody who's seen what I've seen buys it. And yes, I own it, and I've owned it for a long time. But you know, when you talk about who buys it, it's people who understand the consequences, the impact that it's going to have on their family, the possible dependence on children. You know, nobody wants to the people that they spent their whole lives caring for, rearing, and financially helping and everything else, they do not want to flip it back on them and need their help later in life. Those who have assets, you know, if you got assets to protect, you definitely want to do, you know, you definitely want to take the steps to protect it. I will tell you, as it relates to retirement income and assets, this is even more prevalent among couples. If I were to take a couple, put them into separate rooms and ask them each individually, what's your net worth? I can tell you that they're both going to give me the exact same answer because they see themselves as having a pool of money together. Unless it's a second marriage, they generally do not say, well, I've got this and my spouse has that. They talk about it together. But what happens if one of them has a substantial chronic illness situation and it starts to dramatically drain that pool of money? Not a situation that anybody wants to put their spouse in because they were the one that drained all the money, while that spouse is now having to change their lifestyle because the retirement assets got too small. People want to be able to choose their care options. And that's there is a lot of different levels of care out there. And I encourage any of you that if you see articles or you read things that say the average cost of care, take my word for this, you do not want to be getting average care, whether it's at home or in a facility. The average facility is not a place you want to be. And so you recognize that the number that you're seeing for average care, you need to be well in excess of that number. You do not want to be getting average care out there. And then obviously people who buy this, you know, obviously I already said they have assets, but they've got some tolerance for the premium. It's not inexpensive, but I can tell you, nor are the claims. They are rather substantial. So at this point, I can tell you that the best advice that I give to anybody is this is something you should be talking about with your financial advisor. And be prepared, because in many instances, the question that's going to get asked is, well, which asset or group of assets do you have that you'd like to see sold off to provide care for you? Because that's really how this works. And market timing it and everything else, that you don't know when you're going to need the care. Is the market going to be up or down? Or if you own real estate, are you selling off real estate? What are you doing to raise the necessary capital to do this? And how much income can you devote to this while not taking it away from something else? So we talked in the very early part of our discussion today about the consequences. Discuss the consequences with your financial advisor. It's not about whether or not this is going to happen to you. It's about, what if it does? What will it do to the people I care most about in the world?
Fantastic.
With that,
yeah, fantastic, Michael. I really appreciate that. Having a cogent conversation with your advisor is something that can lead to very meaningful discussions. It can mean to between spouses. It can lead to great discussions with your children around you. Also, it can lead to you explaining to them just about the dignity and independence that you want. So I am so appreciative of the financial considerations, and there are so many other things, Michael, that can be considered also. So go ahead.
Go ahead. Are there, I think I saw a question or two in the chat. I'm not sure. I've been watching other stuff. Forgive me.
Yeah, we've seen a number of chat questions. I'd like to summarize some of them and throw them out to you. By the way, I would just like to thank all the attendees for coming. Many of them are clients of ours. Some of them are people that we know personally. We just appreciate how your lives personally have been affected by a situation with a parent or even another family member. So, Michael, you've touched on a lot of things that we've actually heard articulated either in our personal or our professional life. So thank you for that.
You bet.
Let me take one question quickly here that we see all the time is I want to remain at home for as long as possible. I want that independence and dignity there. You did mention a family member and how deleterious it can be on them. We've seen family members had to quit their jobs early, stop saving for retirement for themselves. Really a hard way to do. Is there any way that you could have a family member help out when it's still manageable?
Quick answer is yes. And let me answer that question in two parts. First, as far as staying at home, nearly every quality plan in the market provides benefits, whether you are receiving them at home or in some sort of a facility. And admittedly, nearly all claims start at home. In other words, nobody goes along perfectly fine and just falls off a cliff unless they've had a major incident, a stroke, they were involved in an accident, had head trauma or something like that. Most people, if they are, the average claim is more of a gradual thing. Somebody is getting gradually worse over time. And for many, that means that the claim is going to start in the home. I mentioned earlier that Genworth has the largest block of traditional long-term care business on the books in the country. And I will tell you that they report to us that 3/4 of their claims are to provide services in the home. So only 1/4 of their claims are actually paid to facilities for facility care. Most of this is at home. Now, as far as having a family member, a son or a daughter, or perhaps even a spouse taking care of you at home, if that looks like that's going to be part of your plan going forward, I might encourage you to look at what we call an indemnity plan versus a reimbursement plan. And without going too far into the weeds here, I will tell you, an indemnity plan pays out the benefit in full to you if you in fact qualify for claim. So if you've got a cognitive impairment, you qualify for claim on an indemnity plan and you've got a $5,000 a month benefit, the insurance company sends $5,000 a month, no ifs, ands, or buts. On a reimbursement plan, you've got the same condition, you qualify for claim, but you will provide to the insurance company the receipts for what is being spent for your care, and they will reimburse them. If it's a family member who's having to quit a job or make changes in their life to take care of you, and you would like to see that family member get some of this money, then consider an indemnity plan, not a reimbursement plan, because it will be difficult to get reimbursed for services provided by a family member.
Oh, that is great. Thank you. And thanks for opening up that look underneath on how these work and how just the numbers are impressive for people to stay home and be able to get that care they need. Another question we had from an audience member, from an attendee today, talks about give us a range, a medium to high, like premium tolerance that people who have strong financial plans. So when we talk of our clients, they are the savers. They are the ones that their financial plans have a extremely strong propensity to work out under all conditions, but they want to hedge their long-term care. They might be single, they might be out of town from their family members. So they want to make sure that they have the things in place. Can you give us a range, medium to high premiums for these hybrid type plans and what they get for what they pay for?
I can. It's a great question. And the quick answer is whether you do it in one payment, 2 payments, 10 payments, probably expect it to be in the neighborhood of $100,000. And As I mentioned earlier, for a lot of people, they own old permanent life insurance contracts. They bought a whole life plan in their 30s when their kids were little. The kids are now grown and out of the house, and the need for that life insurance may have changed. And if there is cash value there, many times it is the cash value from that policy that will be used to fund some or all of their plan. Or as I mentioned earlier, a lot of people like to pay for this during their working years. They may not want to part with 100,000 right off the bat, but 10,000 a year for 10 years and get it paid off. Once you've made the payments, whether you pay over 1 year, 2 years, 5 years, whatever it is, as I mentioned on a previous slide, it's guaranteed. So if I make one payment of $100,000, I'm done. The insurance company cannot come back later and say, well, we want you to pay some more money because the cost of this stuff is greater than we expected or what have you. These plans guarantee that you will not be required to pay more premium than what went in. The other part that I would say to you about this is when you say, what will it cost? This depends very, very heavily on your age and the underwriting. So recognize that while there are relatively few people that are completely uninsurable for life insurance, there's a lot of people who are not insurable for long-term care insurance. And the biggest cost, so to speak, in my opinion, is waiting too long, winding up with a health impairment, and then you can't get the coverage. That is what happens to people. I mean, that call must come in from advisors every single day. My client would really like to get long-term care, but they just had, something significant. Well, unfortunately, I can't buy homeowners insurance on my house if it's already burning. And you can't buy this once there's already been a substantial medical situation.
Fantastic. That sounds great. One thing I'd like to point out too is that you talked about the either lump sum or over a few years or 10 years. One of the things Kelly Stanley and I have done multiple times with clients is actually help them weigh their different mandates of where they're at in their savings. So if you have multiple things that you're saving at, a 10-year plan might be best. You're going to pay a little bit of inherent in that, of cost to do it over time. The time value of money shows that if you pay it earlier, it should be cheaper. But if you just don't have the liquidity or you're not quite fully funded on your other obligations, sitting down with a financial advisor like us, an independent fee-only financial advisor, someone that doesn't share in the commissions or any of the cost of buying this policy, and giving an objective view of, hey, you have a lot of mandates here. Many of them are well along the road. This one, not so much. That one, not so much. So let's apply some capital to here, some capital there. It's really a meaningful conversation to better understand your options and to make more informed choices. So Michael, thank you for that. And thanks for that opportunity to actually talk about a financial planning session can really help make those decisions better. One thing I'd like to finish up with, Michael, as we draw closer to the bottom of the hour here, is I've actually heard people articulate this exact pretty much way of saying it. My mom had a policy and we really didn't like it because the claims process was arduous, difficult to understand, and I really don't think we got paid as well. Talk about the claims process and, is it worth it to use these kind of policies?
It's a great question. And I will first say to you, this doesn't work like medical insurance where you're fighting with the insurance company because my doctor prescribed this medication, but the insurance company will only, do the generic or some other thing, or, it just doesn't, my experience is the claims are not like that. And in fact, again, most of the better companies have these wonderful claims departments that they know, for example, who are the care providers in your area and can provide the names, and they can give you ratings on those care providers, who are the better care providers. So especially if you're in a situation where you're in one place and your children, or perhaps you're the child caring for a parent, you're not in the same city, you have no idea who to call in those cities. The care concierges, that many of the carriers call them, are there to help you locate the necessary care providers to take care of your loved one or for you to be taken care of. And by and large, most people report that the claim situation goes very, very smoothly. Now, you mentioned the arduous process, and I will tell you, if there's any part of it that has, I guess, confounded people a little bit, it is that you have to turn in receipts. And years ago, that was a bigger process than it is today. Most of your better carriers today, once you are on claim, and if you are receiving care at your home and it's pretty consistent and regular, that it's the same care provider, the same number of hours, those bills can actually go straight to the insurance company to be paid, and it can be set up that way, as opposed to your family member having to collect those bills, send them to the insurance company, and wait for the reimbursement. It can actually happen on a direct basis today, which is a little bit different than it was years ago. I guess what I would say to you is I think the claim situation is as good today as it has ever been as it relates to these types of plans. And if you are super concerned about that and you really just don't want to have to deal with any of it, or you don't want your family member to have to deal with it, buy an indemnity plan instead of a reimbursement plan.
No, fantastic. Fantastic. We appreciate that advice. So, Michael, I just want to say thank you. Thank you for the investment you've made in us and in our clients and our attendees today. We really appreciate that. Thank you.
It is my pleasure. I am delighted to have been asked to be here. I thank everybody who's on the call here for taking some time to listen in. It's been a delight.
Oh, that's great. Thanks. The one thing I've learned over the years is that life is really uncertain, Michael, and that maintaining your health is an important goal for so many of us, but it can be just so unpredictable. Much like you need a financial plan, and that needs to drive your investment plan, I think you also need an advance plan. An advance plan looks at all the important things like tax efficiency, estate planning, charitable giving, so many things, but especially risk management products as the ones we've been talking about today. That advance plan will allow you to look out into the future and make sure that whatever comes your way doesn't derail the best laid plans that we all see ourselves making. So big dreams, and I have many of them myself, and so do many of our clients. Big dreams require a plan. Caring well today can give you such big rewards for tomorrow. We ask everybody that they should secure their financial future by having a conversation, developing a plan, and making sure it's really applicable to your own situation. I'm going to challenge everybody on the call today and all the other people that are going to watch this as we've recorded it and we'll make it available. I'm going to challenge you with an action item. What are you doing today to secure your financial future for you and those you care the most about? What are you doing today to secure that? What plans are you making for you to live the best life you can? Thank you. Kelly, I'm going to turn it over to you.
Yeah, so thank you, Michael Tesler, for being our guest today. We certainly appreciated all of the insights and information you shared with all of us. And it has provided a great benefit to our clients and all those listening today. For all of those in attendance, in the chat box now, you will find the link to schedule a phone call with Michael or I if you would like to discuss your financial future in greater detail. And we would also like to invite you to a follow-up to this webinar, which is going to be 1 month from today, actually on March 23rd, where we will be talking about preparing to care for your aging parents or yourself before a crisis. And we will be welcoming Katie Casey and Aaron Voigt, specializing in elder care law. And the link to register for that event is also, or that webinar is also in the chat box. We realize that taking care of our aging parents or a spouse is one of the most important roles we will take on during our lifetime. It is also one of the most daunting and demanding roles we will ever experience. If you or your parents are getting up there in years, preparing and making decisions on their care before a crisis happens is the best case scenario. Preparing a care plan in advance of a crisis gives you or your parents the ability to have a say in their future, to maximize independence and quality of life, to improve the chances of aging well and aging in place. So we hope that you are able to join us for that event happening in just 1 month. So thank you all for attending today, and we hope you have a great rest of your day.